Welcome to the YouTube channel for On Call Capital. My name is Bobby Jones, and I'm a retired CRNA turned apartment investor. When evaluating apartment buildings, a simple grading system is used to classify different assets. Similar to a report card, apartments get a letter grade ranging from A to D. And no, there aren't any Fs. Those kinds of buildings would just be torn down anyway. So let's look more closely at these different asset classes and how I determine which ones to invest in. Class A apartments are the creme de la creme. They're at the top of the class. These are luxury apartments in the best neighborhoods with access to the best schools. You'll also find that they have the finest features in the apartments themselves: granite countertops, stainless steel appliances, hardwood floors, exquisite tile work. They're often newer in construction as well. These complexes don't skip on amenities either. It's common to see clubhouses with full service gyms, resort style pools, rooftop patios, and the like. As a result of these features and amenities, these apartments also command the highest rents from residents who often have high paying, relatively stable jobs. Moving on to Class B apartments. Now, these may be a step below Class A, but they're still, pretty great apartments. They're often in nice neighborhoods and close to nice shopping and entertainment. They tend to have good features as well, with nice but not fancy kitchens and bathrooms, high quality hardwood look-alike flooring, and solid surface countertops. While they tend to be a little bit older than Class A, built within the last 20 to 30 years or so, they tend to be very well taken care of. Amenities can vary, though. Some may compete with those Class A amenities, while some are more sparse in nature. It all depends on the market you're in. I think the main thing here is that there's just more variability in the Class B assets than there is in Class A. As such, Class B rents are generally lower and appeal to more of a working class resident profile. That target is actually a huge benefit to investing in Class B assets, though, and we'll get to that later. Class C apartments. Well, let's just say if I ever received a C in school, my dad would have been all over me. No, getting a C is not terrible, but it's not exactly what anybody's really shooting for. That's kind of what Class C properties are like. They're just kind of there. They're not falling apart, but they're not catching your eye either. They're in okay neighborhoods with okay schools. There's often some kind of deferred maintenance on this property, whether it's an older roof or peeling paint, dated kitchens and bathrooms. While some may like that vintage look, most folks would prefer some upgrades. And this opens the door for potential investors to come in, provide some improvements, amenities, and operations, and profit from those. Again, these properties appeal more to working class folks who have less wage flexibility. It's not necessarily a bad thing. Often some of those folks are the best residents who you'll have. They're rock solid on paying their rent, but they're just priced out of their local real estate markets. You can also have a small percentage of Section 8 residents as well, depending on which market you're in. Class D apartments, though, we started from the top and now we're here. We've reached the bottom. Class D apartments are places that you would generally avoid living in yourself. There's usually plenty of deferred maintenance to go around, a lot of neglect. They're also in rougher areas of town with poor schools and potentially crumbling infrastructures. There's also a higher percentage of Section 8 residents in general. Some investors actually like investing in these areas, though, and they do very well. They've built in larger contingencies for expected problems such as increased evictions, rent variability, and property damage. And they accept those challenges as a part of doing business. They often enjoy that automaticity of Section 8 payments. Okay. They get those from the government. Those come in on time every month, after all. These properties aren't really my cup of tea, though. And so, how should you invest? I mean, that's probably the reason why you're watching this video. That's what you really want to know. Well, unfortunately, I can't really tell you that. I don't know you per se. So it all depends on your own risk tolerance, the involvement that you want to have in a property, and the perceived community impact that you want to have with your investment. You can be successful in any asset class. There are investors in all four of these areas that are just flat out killing it. So for me, though, personally, I prefer to diversify amongst Class A, B, and C properties, with most of my focus on the sweet spots of Classes B and C. The middle class assets provide the most potential value for investors while greatly impacting the communities around them. So, why are Class B and C so great? Well, they present more opportunities for adding value to the properties than, let's say a Class A property does. They have strong bones, but they need cosmetic upgrades to improve improve their appeal to residents and increase those potential rents. These are kind of like fix and flips, but they're just on a much grander scale. Operators are providing value to residents through upgrades. The property's worth more because rents tend to go up over time, and the operations are run more smoothly, so it costs less to run these properties. It's a win-win for residents, for operators, for investors. Everybody involved gets a win here. Plus, B and C properties are the most recession resilient asset classes. There's always demand for these types of properties. In good times, people want to upgrade their lifestyles. So Class D moves into C, C into B, and so forth. This shift makes Class D more vulnerable to vacancies in good times. Conversely, in down markets, people may make less money, and a similar downward cascade can happen. Folks may find it harder to afford the finer lifestyle offered by Class A apartments, so they'll move into B and B into C, and so forth. So I don't know if you've noticed either, but there isn't a whole lot of workforce housing going up lately. If you do see new apartments in your community, they tend to be Class A. And that's a result of the increased labor and building costs. Those Pacific Northwest forest fires are really affecting the lumber market, and those prices have skyrocketed. So that makes the higher revenues from Class A properties much more attractive for builders and investors. If you're going to build something, you might as well make more money for it. As our population continues to rise, though, we're really starting to see the effects of shortages in workforce housing. Essentially, this translates into higher occupancy rates for those Class B and C properties above other asset classes. And the demand there also tends to drive rents farther up. At On Call Capital, I work with experienced operators in markets across the country to provide investors with the best apartment investing opportunities. I focus on Class B and C properties with a little bit of Class A sprinkled in from time to time. This allows investors to build wealth with great cash flow and steadier returns above those of the overall stock market. That's going to do it for this video. If you enjoyed learning with me, I hope you'll click subscribe and stick around. If you're interested in apartment investing, make sure you visit my website at www.oncallinvestments.com and sign up for our newsletters where you get exclusive access to new offerings and content. I'll see you next time and on the next video.